world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by two excellent guests to discuss recent developments and new opportunities in emerging markets fintech. Ameya Upadhyay is a principal at Omidyar Network, an impact fund that has deployed over $1.3 billion over the past 10 years. Asad Naqvi is the managing director of Apis, a growth stage private equity fund focused on emerging markets. We originally connected with Ameya in episode 39, way back in May 2017. If you like today's topic, you should check out that one at www.bankingthefuture.com. In today's conversation, we discuss the importance of cash and human touch points as a part of the innovation equation in emerging markets, why fintechs are overvalued, how raising a Series C is similar to turning 40, where the most recognized fintech players in cross-border payments have fallen short, and much more. As always, connect with us on Twitter, Facebook, LinkedIn, or on our website at bankingthefuture.com. If you like today's episode, please subscribe on iTunes or your podcast platform of choice and leave us a review. Thank you very much for joining us today. Please welcome Ameya Upadhyay and Asad Naqvi. Ameya and Asad, welcome to Rebank.
Thank you for having me.
Thanks, Will.
Well, Ameya, welcome back to Rebank, because you joined us, it must have been about a year ago.
Yeah, feels like ages.
Wow, yeah. I'll have to go check and see what episode number that was so we can direct people there to get kind of the backstory on what you do, what Omidyar does. So you were good enough to connect Asad, kind of loop him into this conversation also, because I think you guys have similar interests and kind of looking at basically the, to an extent, emerging markets, but not exclusively, ecosystem, and thinking about effectively how to bring a lot of the innovation that's happening in financial services and I believe other verticals in your case to markets where it might be even more impactful than it is in the likes of US, UK, Western Europe. Maybe just for kind of quick background and context, and so people can recognize voices. If you want to just real quick intro, and we'll pick it up from there.
Yeah, so I'm Ameya. I work for Omidyar Network, which is an impact investment fund. The focus of the fund is to empower individuals to improve their lives and the lives of those around them. And we do that by investing in early stage companies and supporting change makers across the world. Behind this mission, we've invested about $1.3 billion in the last 10 years. And yeah, that's the quick intro.
Hi, everybody. Apis is a financial services and I guess financial infrastructure focused private equity fund. Growth stage, and also with a strong emphasis on growth markets, which is our way of saying emerging markets. And for some of the same reasons, you laid out, Will, which is that there's a lot of the innovation happening in financial services is especially impactful and meaningful in markets where the formal financial system doesn't really reach many people to begin with. So that makes some of the innovation a lot more easily adopted, as well as a lot more powerful in broadening and deepening the reach of the formal financial system. And it's that commercial opportunity and it's that impactful opportunity that drives our investment mandate as a firm. We're, as I mentioned, growth stage. We provide growth capital and are raising our second fund now focused on Africa and Asia.
Mm-hmm. Great. So Asad, before we started recording, we were just kind of chatting through some some ideas, and we talked about basically this concept of finance becoming invisible, and it's certainly a topic that we've talked about on the podcast before. It's a topic that I think a concept that many of our listeners will be very familiar with, right? Because it's wow, like you jump in an Uber and you pay without realizing it. Okay, like we've been over that ground before, but I think the perspective that you brought to it, Asad, was interesting because from an emerging markets perspective, often it's kind of the first touch point with the financial services system can be a product that isn't necessarily a current account or a loan, but another kind of entry point that embeds a financial service, but it may not explicitly look like one. And then that kind of creates some interplay and dynamic in those communities. Maybe you want to pick that up.
Sure. Yeah, very much so. So in our, in a lot of these markets, say rural Africa, a household or an individual may not have had any contact with the formal financial system in any meaningful way. So definitely not a current account or a home loan or something of that nature. And so often the first experience with financial services is often through what we call contextual financial services, or some people may call product-led financial services. So buying a good from a retailer in a village and paying for it over time. So effectively there's financing embedded in the sale because you're paying the shopkeeper over the course of a month, as you build up a little bit of some savings, so we think in doing so, if done right and done properly, the potential to broaden the financial system is actually quite tremendous, because if something like this is tracked, there's a little bit of technology thrown in. Not only can you sell, the actual physical product, but in embedding the financing, you can also help a household establish a financial identity, establish a repayment history, potentially a credit history, and then perhaps some collateral with the product that the physical product that's been sold. And so another example could be, these off-grid solar home systems. You put a panel on the roof, lights up 3 light bulbs. You've suddenly got light because you are in an off-grid household. But actually, you've been paying for this over time through mobile money, let's say. And in doing so, you now have financial identity, repayment history, credit history, if you will, and collateral in the device. If you don't make a payment, the device doesn't work. And so, therefore, you have an incentive to pay back that financing, although you're not thinking about it as such. So for sure, for us, contextual financial services and this kind of product-led approach is important as a gateway to broader financial services as we think about them. Once you've identified the customer, you can think about an education loan or an insurance product over time. And so, we think it's a pretty exciting area, and that way, it's also a way to make financial services prettier and more useful. In the process.
I think it's a great point. Ameya.
I'll pick up on that, and I think, as Asad mentioned, I very much agree with him. One way to embed finance in the real lives of people is through products, right? And off-grid solar is a great example of that. I think the other way to do that is to make products events-based, life events, right? Kids going to college. Instead of telling me this is the lowest APR student loan, help me get that event smoothly. Help me control my finances for that event. So a provider, instead of selling loans, would be selling a package which helps you take control of that event in your life, right? Save XYZ, take loan of this much. Here's a university you can apply and embed my loan to that application. And if successful, it's an automatic dispersal. I'm making this up, but the point is that there are certain life events around which we particularly need finance. And that's one way of embedding finance into people's real lives. I think the other one is behaviors, right? How can I use existing social behaviors and weave finance into that so that the adoption is easier? I am not in my product looking to change behaviors, but utilize them. I mean, one big example of that is, of course, WhatsApp and WeChat offering payments. In India, WhatsApp started payments 2 months ago, and they already have 1 million people on, right? Because people are used to sending messages to each other. In fact, in Kenya, they did a research, Karubi Digital, which said that the biggest app people use before and after M-Pesa payments is WhatsApp. Because folks are going, hey, do you need this payment? I'll switch over to M-Pesa, make that payment, switch back to WhatsApp. So how do you prevent that switch? How do you embed finance into a chat? Because normally, that's how we interact with each other. So I think more than just a way to reduce distribution cost, this is about changing the calculus a provider has with the customer and becoming a mentor as opposed to a financial service provider. You know, it's a big ask, but that's, I think, the ideal state.
Yeah. Asad, are there any companies? So I understand that you guys do a fair bit of kind of like infrastructure type investment, investing in players who may not be traditional banks or insurance companies, but kind of providing components that enrich the ecosystem. Are there any particularly interesting companies that people might want to hear about?
Sure. I mean, even the very basic infrastructure is interesting to us. I mean, even a company that's, providing cash in transit, cash in trucks, it's not, it's a logistics business, but it's interesting to us because, it's, ultimately helping to reduce the cost of financial intermediation, taking over a critical function that, let's say, a bank doesn't have to do itself. But then there's really a lot of potential for a company like that to move up the value chain. If it already has a lot of the financial institutions as customers, and if it's thinking broadly and creatively, to then position itself to take over, other functions. There's, perhaps cash processing, perhaps ATM management, and then, payments itself, develop a switch. And we've seen that progression in a number of markets. And so to us, I guess, as an investor, these sort of what we call financial infrastructure businesses are exciting because they're sort of further plays on the growth of the financial system, and especially as it broadens and deepens, as I mentioned earlier, and are often very scalable models as a result, and so offer potentially, quite exciting returns as opposed to, let's say, a bank in a single country where, unless you time it perfectly, your upside may be a bit capped, and then the regulator can always ask you for more money if you're a shareholder of reference. But I've digressed a bit. But the point is, financial infrastructure, broadly defined, is quite exciting to us because, before you can, at a very basic level in the markets we cover, before you can offer somebody a loan or an insurance product, you need to connect them to the system. And it's often through these sorts of providers, whether it be, a company helping merchants accept non-cash payments, card payments, online payments, mobile money payments, whether it be through companies that are, just handling the POS devices that enable a lot of the payments activity. These are quite exciting and scalable models for us.
Mm-hmm. And I guess that point around cash and cash related infrastructure in the markets in which you invest is particularly relevant because you said something kind of provocative when we were chatting before, which was around basically one of the best ways to get people to put and leave cash in your ecosystem was by making it very easy to cash out. Maybe you can kind of talk through that dynamic.
Sure. Yeah. Straightforward thought. Just that. I guess it's. Everyone talks about how it's all about whether it's a wallet or whether it's a payment service. The ultimate goal is to keep money in the ecosystem, in your own ecosystem. And there's a number of, whether if you're PayPal, if you're Ant Financial, whether you're WeChat and so forth. Giving people more options to cash out helps convince them that the money they have in your ecosystem is more useful, and therefore they're more inclined to keep it within the ecosystem that you've built. Mm-hmm.
Yeah, and I like to think of this as, if you didn't have ATMs, would you store your money in a bank? At the cost of sounding blunt, Asad, I think closed-loop models are dead. I also think there's absolutely no use for wallets, which mirror bank accounts. Money should be stored in bank accounts, which is interest yielding. And the only reason people came up with closed loops, semi-closed loops, and wallets was to increase the utility of stored value, as we talked about, right? So if you, in India, for example, if you transfer money to a Paytm wallet, the reason Paytm started was it's so hard to pay your electricity bills and utility bills out of your bank account. Paytm just made it easy to recharge your phone, pay your electricity bills, and do the stuff that you should expect to do from your bank account. But it was difficult because the infrastructure was lacking. But I think that's an infrastructure problem that is being confused as a retail problem. It's not a retail problem. You should not need wallets. What you need is something akin to unified payment interface in India, which is an any-to-any real-time interoperable payment system. So, it's not about making better cars. It's just about mending the roads.
Yeah. Well, it's interesting because it kind of sounds like you're
Interesting.
also describing like the crypto ecosystem. One of the biggest challenges to solve is interoperability, and how can we easily convert from one currency to another. That's kind of the same point that you're making, which is that it's an infrastructure problem. It's not a kind of a use case problem.
Yeah, I mean, I think, and of course, I am imagining a utopian ideal world, at least within a country, and we've talked about cross-border payments, and Asad, and maybe you want to talk about it later, but at least within a country, it should be very easy for me to transfer value from my stored value account to your stored value account. And that's a shared infrastructure that I think is absolutely necessary for a thriving financial ecosystem. And one thing I forgot to say in my introduction is that I focus on financial services for Africa, and I am seeing a lot of countries in Africa adopting the India model of having an identity layer in Aadhaar and then a ubiquitous interoperable payment layer. Nigeria, for example, NIBS, which is the Nigerian Interpayment Corporation, is building this infrastructure. It just reduces the cost in the system. Mm-hmm. You don't have to have wallets and closed loop systems. It's just, it's like the internet. When the internet started developing, AOL wanted its own walled garden, and here are the websites that are on my system, and so on and so forth. Now people laugh at you if you don't choose your ISP's basis how many websites they allow you to access, right? So I think in payments would develop in a similar way, where people will play on efficiency and value as opposed to closed loops.
Yeah, I mean, a couple of things there. So agreed on NIBS in Nigeria, right? I mean, the regulation in a lot of the developing world is actually quite dynamic in that it's not just directives, focus on financial stability and, of course, financial inclusion now in the last 15 years, but the regulators are building infrastructure, which is quite exciting. So yeah, UPI, NIBS, etc. They're allowing single points of connection to multiple banks, utilities, etc. And so they're laying doing much more than writing papers, but actually making a lot of what we're talking about possible by creating the infrastructure to enable it, which I think is quite exciting. And the India stack may be traveling. Although I also give the Nigeria example. I'm waiting to give a few more, but I think they'll come. They'll come. There'll be a few more. But listen, the other thing you said though, I agree. So wallets don't need to exist necessarily, but they do for a reason, which is that banks have just been so bad, not just in the developing world, but everywhere at that retail effort, right? The banks in developing markets serve, the really wealthy or the large corporates. That's about it. And for a long time, there wasn't a business model to serve, the rest of the population. It was just too expensive. You'd have to build a branch. You'd have to put up an ATM. ATM would cost more than probably the annual income of the village that you were, putting it in. But even now the technology has made a lot of that easier and cheaper and made distribution much more pervasive and useful. Even now there is this cultural constraint mindset issue with banks going after the retail opportunity properly. So I mean, you're on the earlier stage. You probably see a lot of models. I mean, what do you think? That's just because some of the bankers have been around too long and they need to sort of die for some younger guys to come up and think about new ways of doing things? Or do you think there's more that needs to be done in order to help make banks, take on the challenge that, you threw down, which is to make wallets obsolete?
Yeah, I think one of the biggest advantages of having a thriving fintech ecosystem in any country is not the impact that the fintechs themselves have, because by and large their impact is still very nascent, but it's to shake up banks. Again, going back to the Indian example, I think the biggest shake-up which happened when new payment banks and small finance banks were licensed is the big commercial guys shook up from their oligopoly and started addressing the same market segments that these two banks were supposed to address. So yeah, I first of all, I fully agree with you, Asad. I think wallets serve a purpose still, and I think they will continue to serve a purpose for the next few years till bank accounts become ubiquitous. But I think that journey has started, the ball has started rolling, and fintechs are pushing banks to do this, even if they themselves will not be successful at the game they're playing, but at least they will get others moving.
So you say fintechs won't be successful at the game they're playing. Why is that?
No, that wasn't a blanket statement. We invest in fintech, so I very much hope that at least our portfolio is successful.
But you'd be happy if they're just shaking things up. So you'd be happy if your investees are just successful in throwing eggs at the houses of the older bankers and they're shaking them out of their stupor.
Well, if they are to fail anyway, then that would be an upside. I do think, though, there is an existential question to answer for at least some of the monoline fintech businesses. How do you make money, right? For example, if you're an auto savings tool, which takes money from your bank account and puts it in another vault to develop a savings habit, digit-like play, which we are seeing a couple. How are you going to make money? You're not allowed to invest that fund. You have to keep it at a trust account. Banks usually will bully you to not giving you anything. How do you make money? Financial aggregation apps, a personal finance manager. How do you make money? So, I mean, and when we start talking about this, you kind of go back to the old age time value of money argument, right? You make money on credit intermediation, you make money on interchange on payments, and there are only these 4 or 5 revenue streams or subscription if your service is that good. And I think there is some realism dawning, at least in some fintech circles, where people are like, okay, I can do this fancy thing. This is not going to sustain me. I need to build in some traditional revenues. And what I should play on is not a completely new revenue model, but more on the customer interface and the ease of service and so on. I think that there is that tension.
Asad, I know you have feelings on fintech valuations and their sustainability or otherwise.
Yeah, sure. I have some feelings. Mostly, I mean, I'll keep it short. Mostly that to me, most of the fintech valuations don't make any sense. So I'm a growth stage investor. I come across a lot of companies that have gone through, a few funding rounds already. So call it seed, Series A, maybe Series B. And more often than not, when I show up these days, all I can offer is a down round to the prior round. So that could just be me. And my dark view of the universe, but I think there's more going on, and I think these, especially in the last 5 years, a lot of companies are getting funded at valuations that leave them in a very difficult spot, when they get to their Series C or their Series D, vis-a-vis their capital structure and investors, and that's even for very good ones, arguably very good companies, and that have progressed along the Ameya yardstick, right, and develop real revenue, sustainable revenue models, and have good teams. And so that to me is personally tragic because it means I can't invest, but it also leads to me thinking these valuations don't make any sense.
No, that's interesting. Literally just yesterday afternoon, I was with 2 friends, entrepreneur friends, who were talking about VC pressure, basically. Pressure in part, but maybe as much, I don't know, call it venture capitalist optimism around, company valuations and what they should be raising at, and almost like setting expectations unrealistically. which kind of resulted in going out to raise money, presumably not from the same VCs who had initially backed them. Guys that will follow on prorated, but that aren't writing the big checks in the next round and saying, actually, this is we should be raising now in a 300 million pre-money versus the last round, which was whatever 80, and those conversations maybe don't go as smoothly as entrepreneurs would expect them to. And of course, you've got kind of motivations and incentives from earlier investors, but how much of it, Asad, in your view, is the responsibility of early investors to kind of set appropriate kind and put together appropriate capital structures which allow growth at reasonable valuations to kind of support long-term success of business, and how much of it is about effectively booking paper gains on up rounds over time.
Yeah, I mean, apportioning blame is always fun,
especially when no one's here to defend themselves.
Yeah, so I mean, I'd love to, but there's to deeper personalize it or to not take names. I mean, it's also it's just there's a lot of capital for. I guess fintech. There's a lot of capital for a lot of things these days, right? And there was the financial crisis. Some could argue, in 2008, 2007, 2008 was because there was so much global capital sloshing about the U.S. And didn't have a place to go, and it found a place to go with subprime mortgages, right? And so, so there's just a lot of capital, and I guess that's fine. What I think though is that at some point there will be. Every company has to go through a reckoning, right? At some point, it's like turning 40, right? At some point, the promise of what you set out to do with your life, it becomes increasingly obvious at some point that it's not going to materialize, right? And so then. But it can also be very clarifying, because then what life is about. In the case of a business, what's a sort of sustainable growth rate. More realistically how many customers you can really acquire and at what cost, and therefore what your sustainable profit is likely to be over time, and that links to valuation. So I think what's happened with a lot of capital is just that the point at which that sort of reckoning occurs for a company when where the fundamentals drive valuation is delayed quite a bit now, through maybe a couple of extra funding rounds, and so that happens a bit later, but then it hurts even more, right? It's as if you didn't go through that introspection at your 40th birthday, but it hits you especially hard when you turn 50, something like that. To overuse the analogy, but so I think maybe the reckoning is delayed, which makes it a little bit more painful, and then me as victim, I'm there thinking as a growth stage investor, damn, everything's really expensive, and but it's not the end of the world. I guess I should stick around a bit longer. And maybe I'll find value there.
Yeah. No, well, I guess there's also kind of a natural point in kind of the startup trajectory where initially you're raising money on a vision, and then you're kind of raising money on probably expand that vision, and that supports valuation, and it's like the sky's the limit. And then at a certain point, someone comes in and stops seeing how far can this go in 10, 15, 20 years, and starts saying, what are your revenues? DCF on your, forward-looking, 3-5 year financials, and making a more traditional, like, PE style investment in a company like that. And you can see where some of that disconnect might come in.
Yeah, exactly. So that's exactly right. So the point at which, you're not going to be Google when you realize that, or the point at which the DCF, you can't be growing, double the rate of inflation forever, right? At that point, exactly. And then, there's usually a guy with a tie telling you this, so it's not very pleasant. but yeah, and that I think that reckoning's been delayed, and you've got the 100 billion SoftBank fund now, right?
Totally true. So we kind of touched on it before, and so I'll shift gears and take us back to kind of some of the points that we had opened with, but distribution, and it's a massive topic, and it's everything from does Facebook, Amazon, Google come to own the front end, kind of the customer engagement layer in developed markets. That could surely happen in emerging markets also, but at the same time, that same concept of distribution is physical agents needing to be involved in an emerging market ecosystem. You mentioned the cash transporters before, and ways to even kind of innovate around the distribution model with that face-to-face component. So maybe it's not just pick up cash and pay a utility bill, but there are other types of financial services products that can be delivered at the same time. Ameya, maybe get your view based on the companies that you're kind of dealing with most closely and some of the opportunities that you're seeing. How do you think about distribution in the markets that you're focused on?
Look, at this cost of sounding completely cliched. I think the digital and physical will coexist, right, for the foreseeable future. I mean, even developed markets like Amazon recognizes that's why they're buying physical stores. And certainly for emerging markets, in Africa in particular, there's no question that you will need a high-tech, high-touch model, right? Also, I like to think of financial services. I like to divide that into tactical and strategic, like low engagement and high engagement. And for me, low engagement products are products that are that don't require a bunch of customer trust or product design and so on. Like P2P payments is an example, right? A short-term nano credit is an example. I don't need to know a bunch about you. I don't need rocket science product engineers to do that. And it's easy to bolt on those products on existing services. And that's why you see Mshwari, right? Payments is very naturally embedded into a communications play. It could be a chat or it could be telephony or whatever. It's just a marginal cost business for these guys. Similarly, I think nano credit, whoever owns the payments layer, it's very easy to bolt on nano credit on top of that because you have payment transactions, you have a captive customer base. So the additional cost of bolting on some of these low engagement products is not that much. And so I think these ones will be captured more and more by super platforms, and that could be Amazon in the US, it could be Alibaba and WeChat and so on in China, and in Africa, maybe one of these guys are homegrown Jumias and so on, right? I think the real opportunity for startups and for innovation lies in the strategic products, which are savings, investments, insurance, pensions, right? Where you really need to understand finance. You really need to understand your customer. You're asking the customer for money up front. You're building trust. There is an entire life cycle and depth to that product, which is very hard for an Amazon or a Safaricom to replicate, right? And they don't really want to do it. That's where I think these platforms will make it easier for other specialists to sell their services by acting as distributors, right? And as these platforms grow and become bigger distributors, I think they will reduce the cost of customer acquisition for these startups and increase competition, because then you can't build a siloed distribution channel. Everyone can be on this platform, and that's good for the customer, and I think that's good for the industry.
That's really interesting. Have you seen examples of that? A proto, example of that where there's a specialist provider successfully riding somebody else's just a broader platform's distribution and using some of the same examples, Facebook, Amazon.
So one rudimentary example is the Commercial Bank of Africa riding on Safaricom's rails, right, for a savings product, which is Mshwari, and savings and credit product. So it's a banking service which is not manufactured by Safaricom, riding on Safaricom Slayers. Another one which is one of our portfolio companies, it's called Pula, which is a crop insurance company. It's very interesting. It is an insurance provider that designs agricultural insurance, which is a very specialized product, but distributes it through the distribution networks of fertilizer and seed companies by sticking a sticker on the fertilizer bag. So in that sense, it's an embedded product because it is embedded in the act of purchasing seed or fertilizer for the farmer. But it's also using a distributor, which is, interestingly, not Amazon or Safaricom, but it's a seed and fertilizer company. And I think we are also, at least in emerging markets, Asad, to your point, we are going to see more of these high-touch distributors becoming an analog of Amazon, right? Tractor leasing companies could be distribution platforms for tractor finance, for example. And there could be a bunch of these other non-internet, non-super platform, non-sexy distributors, which can allow companies to distribute their products cheaply.
Yeah, that and, there may need to be, to come back to my human beings still matter kind of ethos, there may still need to be a cash and cash out point human being to enable even an Amazon in one of these markets, right? I mean, it was Ant Financial that took a big piece of Easy Paisa in Pakistan recently, and that's basically a cash and cash out network, one of the largest in the country. It's run by Telenor, the telco, and it's probably the largest over-the-counter domestic remittance platform in one of these markets based on users. And so I think, I have no special insight into Ant's brain, but I think what they're after is, if they control the cash in and cash out points, they can sort of turbocharge the ecosystem they're trying to build. They can allow more people to buy stuff via mobile online, even those that aren't online or aren't mobile. In a country with 200 people like Pakistan.
Yeah, and they tried to buy MoneyGram, right? So it's a similar logic.
That's right. Yeah. And was Bcash
as well, which is an Asian network in Bangladesh. Another example of a specialist provider using a platform distributor from our portfolio is MicroInsure, which is a microinsurance company that distributes its products through mobile network providers. So folks can auto-enroll into a small insurance product, and the premium is paid by the mobile network operators because that results into lower churn. So that's another interesting example of bolting on a financial specialist.
Yeah, so that point, I guess just for the broader audience's understanding that point about the cash in, cash out touch point, in a place like London, where we're seated today, great, you're on Amazon, whether it's website or through the app, and your card is connected, and there you go. Like you never see your money. Like it arrives in your bank account at some point, paid by your employer, whoever it is. It's kind of moved magically to Amazon, and your product arrives at your door. But in a lot of these countries where you guys operate, where we're kind of basing a large part of this conversation, that's not the way it works. And that's back to the point about why wallets are necessary, because it's difficult to move money around. Asad, you made the point before about how banks, haven't traditionally necessarily offered products to the average individual. It's been for corporates and high net worth. So that cash in, cash out component is core, and it's not going anywhere.
Yeah, agreed. We've bagged two such networks in Africa, Zuna and Pagatek, and for precisely that reason. We think it's critical.
Yeah. So maybe this brings us to the topic of cross-border payments. And we've seen a lot done in a number of markets, kind of supporting new ways of moving money internationally. In fact, some of the most valuable fintechs of the past 10, 15 years have kind of operated in that space. But I guess the question is, have they done enough? Has there been enough innovation in that space?
I mean, I don't know. Looking at Ameya's face right now, I think you've got two haters. with regard to, the new generation remittance providers. No, I mean, I think, listen, a lot of the innovation in cross-border payments and remittances specifically has, to me, been on the front end, right? And there has been quite a bit of innovation and cool approaches. So, on the user experience, I mean, using TransferWise is really easy. It's really intuitive. A company in our markets is Wave. I mean, if you're sending money from the US to Kenya, it's super easy. You need somebody's phone number, and that's pretty much it. And everything else sort of happens automatically, and the money ends up in someone's M-Pesa account in Kenya. And so, on the front end, on the user experience. And in taking away a lot of the clunkiness and a lot of the extra fees that banks used to charge, right? And by making it so easy, and by taking away business that banks were making far too much money on. That said, the way the money actually travels is horribly old-fashioned still, right? I mean, it's through SWIFT, correspondent banks, etc. And so there hasn't really been much innovation in the infrastructure that moves money from point A to point B cross-border. And so often what you find is a lot of the new generation companies, and they're splashing a lot of money that they're raising on the West Coast on customer acquisition. It's a land grab. They're fixing the user experience. They're hiring more product guys. And so that's the activity. But they're often riding somebody else's rails, and that somebody else is often somebody super traditional, because who's done the hard work to go sort of country by country, get the bank integrations, get the licenses, have the cash pick-up points in the countries where that matters. It matters less and less in India with the great leap forward on bank account penetration, I guess, but still quite consequential in the Philippines to offer cash out. And so they're still using very traditional rails, and traditional rails are still the only game in town. So we haven't gotten to a point where you can move money across borders efficiently through a new machine, through a new infrastructure that can do it faster, cheaper, simpler. You can have a younger competitor to Western Union that's faster and more nimble, but it's still set up more or less the same way as Western Union. So that's my beef with the new generation remittance providers, that they don't really think about the back end. They don't have to yet. If we were to tie back to the point we made about valuations and not having to have that reckoning, but they haven't had to think about how long term they can profitably service the remittance volume that they're getting, and the only way you can do that profitably is by having the right platform on the back end with sufficient bank integrations, cash out points, and so forth, across multiple markets, 180 markets, let's say.
Yeah, I'm gonna jump on Asad's grumpy old men trail. I find it ridiculous, the cross-border financial infrastructure. It's like a multi-level marketing system right now. Like 2 big banks in 2 countries have then another level of banks where they have Nostro accounts, and then one more level of banks. I mean, it's ridiculous. And I fully agree with Asad. I think it's just good marketing and fancy apps that have cornered the market, and they are required, don't get me wrong, but it's just on the back end. It's a mess. And it's a mess because it's super hard. It's anything which requires international agreements, it's super hard. But I don't think there are too many companies that have taken on that challenge of fixing the correspondent hops and fixing the encrypted messaging standards that are in disarray. I think Earthport is one company which I like, which is trying to fix this. It's an incredibly hard thing. Swift is now shaking up and trying to change itself, but it's appalling. And this is one area where maybe potentially, despite my general skepticism, Bitcoin has a role to play. I don't know. It requires liquid exchanges on both ends to make this work, which are not available everywhere. And then you have the question of volatility and price risk on either sides. But that's one potential.
Blockchain is maybe more so than Bitcoin per se, but and then potentially, if you solve the liquidity issues and the convertibility issues for Bitcoin, then maybe Bitcoin. But anyway, that's aside.
Yeah,
I very much agree. And the earlier point you made about when the example you gave of WhatsApp in India, right? I think that should be very scary to a lot of firms in the context of domestic remittances or domestic peer-to-peer money transfer. However, someone like WhatsApp, if they needed to do something cross-border, I don't see how they would, given the complexity of what you described, the Nostro account upon Nostro account, or how ugly the back end is, and therefore how much you need a specialized skill set or experience to be able to navigate through that. I think somebody like a WhatsApp would have to acquire, I think, a specialized money transfer operator in order to be able to deliver on the user experience that they've gotten people used to in the context of domestic payments.
Yeah, agreed.
Excellent. Well, a call to arms for the entrepreneurs out there. We've got a venture capitalist and a PE investor right here, so you guys can fund them straight through to I don't know. To whatever, to world domination.
IPO.
Exactly.
That's right. These are the only two people you know.
That's all.
And SoftBank.
Yeah.
Excellent. Ameya Upadhyay of Omidyar and Asad Naqvi of Apis. Thank you very much for joining us today.
Thanks, Will.
Thanks, Will.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.